Once again, a warm welcome to all of you at ASK Investment Managers Quarterly Call. I am Gaurav Chakravarti and I'll moderate today's call for you. Let me begin with the current mood of the economy, wherein the world is awash in an ocean of uncertainty, whipped up by hurricanes in the form of geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and overall policy uncertainty, including political spillovers during the great election year, wherein more than half of the world's population faces the ballot box. Amidst these headwinds and contradictions, the Indian economy is sailing through smoothly, and I must say, India is scripting a beautiful tryst with its financial stability, powered by buffers like strong macroeconomic fundamentals and a resilient external sector. Our net capital inflows have been generally exceeding the current account deficit and contributing to accretion in foreign exchange reserves. India has the fourth largest foreign exchange reserves in the world, standing at around $682 billion, which is sufficient to cover the entire external debt and about 12 months of merchandise imports. All this reflects the resilience of the economy to sustain its growth path amidst ongoing geopolitical headwinds. And that forms the part of our discussion today. And for that, we have Mr. Sandip Bansal, Senior Portfolio Manager at ASK, with us to assess the condition prevailing both in terms of global and domestic market. He shall take us through the highlights of our ASK growth portfolio. To remind you participants, ASK growth portfolio being one of the industry's first PMS investment approach, launched way back in Jan 2001, and now has a track record of more than 23 years. And in this period, it has compounded at a CAGR of 19%. To put it into a number, 1 crore invested in ASK growth in Jan 2001 stands at 60 crores right now. Sandeep comes with a 2 decade of work ex with more than 15 plus years in equity market. He has been instrumental in managing our portfolios since the time he has joined us from SBI Live, where he was the head of investment research leading across asset classes. He comes with a strong educational background. Sandip is a chartered accountant, company secretary, and an MBA from IIM Ahmedabad. Today, we have scheduled an hour for this webinar, wherein I would request Sandeep to cover broader trends of the market and the growth drivers for our economy, followed by a deeper understanding of the strategy, insight on what happened this financial year so far, where we stand now, how we see things going forward. This will be followed by question and answers. So I request all the participants to type in your questions and queries. We shall curate and try them answered. Over to you, Sandeep.
Sure. Thank you so much, Gaurav. Thank you everyone for joining the call. Gaurav, I'm sharing my screen and hopefully it's visible.
Yes.
Please do let me know.
Yes.
Sure. So firstly, the big news was in the quarter was the elections in the US, where we saw the Republicans winning the Senate, the House, and obviously the presidency. The inauguration of the new president is in January, and there are a lot of expectations around change in trade, energy. There'll be tariff, non-tariff barriers implemented across various countries. So that is something which we are going to watch. Net, what is generally believed is that Mr. Donald Trump is going to be positive for businesses in general. We could relatively benefit as a country if potentially there are higher tariffs imposed on China versus India, but these are things that we would be carefully watching. China has announced monetary as well as fiscal stimulus to revive its economy. It has still got some firepower, which it has kept in reserve because it is waiting for the new dispensation in the US to roll out its policies. And if there are any implications on trade, it will accordingly react. So these are the uncertainties that the whole world will be watching in the next calendar year. Europe continues to witness subdued growth, obviously because of the conflict over there. Global GDP growth is actually being supported by the US and to an extent by India as well, because China and Europe are not growing as per their potential. On the monetary side, we've seen the US Federal Reserve cut interest rates by 75 basis points so far, and they have said that they would be data dependent and they would also wait for the fiscal policies and other policies of the new government. Uncertainty of the two geopolitical conflicts continues. There is an expectation in the market that these conflicts will start to mellow down from next year, given the change in the US regime. And if that happens, it's going to be positive for risk assets, it's going to be positive for equities because it will remove uncertainties. It will also cause global growth to start to witness an uptake. The supply chain challenges which are there globally will also start to reduce. So these are a lot of number of things that one is clearly watching for in the next quarter. As far as the Indian domestic picture is concerned, we continue to be one of the fastest growing large economies globally. For us, inflation continues to be something that the policymakers are watching because food inflation in India has been sticky. So our rate cut cycle has obviously not started, and it is maybe going to start at some point in next year. Our rate cut cycle is also likely to be shallower than in the Western countries because rate increases in India were also lower than what the Western world had witnessed. The RBI again continues to be data dependent and it wants to kill the inflation demon once and for all, and once it believes that it has come within range, only then would it like to start on the on rate cuts. We believe that it is going to happen perhaps sometime in the next year. What the RBI Monetary Policy Committee has done is obviously change their stance from neutral to neutral versus withdrawal of accommodation, because they are gradually moving towards realizing that ultimately at some point they would need to start to cutting rates. Fiscal deficit in the first half of the year has been much better than what was targeted in the budget, and that was because government spending was actually far lower than was envisaged, and this was impacted because of elections. We believe that that is going to pick up in the balance of the year. Obviously, India continues to be on the path of fiscal consolidation, which is good, and we are likely to meet our fiscal numbers quite comfortably this year. So hence the macroeconomics of the country, the macroeconomic fundamentals, both on the external side as well as the domestic side, continue to be very favorable. What we have seen is that the growth in the last quarter was impacted by consumption. That was the key surprise element in the quarterly results season that concluded. Some aspects of consumption continued to do well, like on the rural side, we've seen signs of revival, but on the urban side, there has been a slowdown. Consumption has also been impacted by the extended monsoons. In Q1, there were extended heat waves as well. In the second half of the year, growth is expected to pick up on the back of revival in government expenditure and also a pickup in exports. This is also being indicated by the management commentaries that we've heard in the quarter gone by. The risks continue to be largely global in nature. The first and foremost risk is the geopolitical conflicts and their consequent impacts, whether it could be on global growth, whether it could be on supply chain, and more importantly, on oil prices. Obviously, we continue to be watchful of them because these things are very difficult to predict in the short term. And we are hopeful that perhaps next calendar year is likely to be more benign in terms of the geopolitical environment globally than the past few years have been. What the world would also be watchful of, as we discussed, are how are the trade measures that are taken by the new US dispensation. It is quite possible that tariffs are imposed on many emerging countries, including India, but at the same time, we could still be relative beneficiaries if some countries, perhaps let's say countries like China, have higher tariffs imposed on them than India. So at an absolute level, we might still be losers, but on a relative term, we could end up being beneficiaries. So these are the key risks that we are watching. On the markets and valuations, so Nifty valuations in the last 10 years have been at an average of around 20 and a half. That is the last 10-year average. Current Nifty levels are about the average of the last 10 years. So one could say that if we see from the perspective of what has happened in the past decade, we are at about average or mean valuation levels. There has been a bit of cut in earnings in the quarter gone by because of the slowdown that we saw in consumption, because of the muted government expenditure, and also because of cut in global commodity sectors like metals, oil and gas, and the earnings of these sectors generally tend to be volatile. But if we look at the bigger and the medium term picture, India still continues to be offering a mid-teen kind of an earnings growth rate, around a 14-15% kind of an earnings growth rate for the next couple of years. And there are not too many, and it would be amongst the few markets globally, large markets, that would be able to offer such kind of earnings growth. And this is on top of the fact that our return on capital, return on equity matrix continue to be amongst the best globally. If we look at the various sectoral earnings, then on the auto ancillary side, two-wheeler earnings continued to do well. This was aided by both volume growth as well as margin expansion. PVs, CVs, and tractors, the performance was more muted. If you look at the banking and financial sector, their margins were impacted by higher cost of funds. Credit costs have slightly inched up. And in most areas, they are not cause of worries, but in pockets there could be. But that inch up in credit costs did impact overall PAT growth. Companies which were exposed to capital markets in the BFSI space continued with their robust performance. On the consumption side, that was in some sense the key surprise of the earnings season gone by. Obviously a negative surprise. Some segments did well, like consumer durables, primarily air conditioners. On the festive season, there were mixed commentaries, but there is an expectation that we will see a pickup in rural demand, which has been aided by the good monsoons. The urban slowdown, especially in the low ticket size, was the key negative surprise, and that continues to be subdued and something which is a key monitorable. On the chemical side, global destocking continued. which impacted the quarterly performances, while there does seem to be some signs of bottoming out, and incrementally and on a sequential basis, things should improve with major benefits starting to show up from the Q4 of this financial year. The entire engineering, capital goods, infrastructure basket was impacted by the elections, the heat waves, the monsoons, and then the festive season. But most of the companies, in fact, all of the companies that we've interacted with, either in the quarterly season or in various investor conferences, we do get some confidence from them that there are pickup in activity levels on the ground. The oil and gas sector, the OMCs especially, witnessed very weak margins in the previous quarter. We've seen margins, refining margins, more than double already in this quarter so far, and hence now the outlook on them seems to be quite good. On the pharma side, domestic volume growth has been stable, and margins had a benefit from lower input costs. So this was on the macro, the markets, and sector-specific results. If we look at our portfolio, the growth portfolio, about half the portfolio does comprise of large caps. About 1/3 or 30% of the portfolio is of mid caps, and around 17% of the portfolio comprises small caps. Our stock selection continues to be on a bottom-up basis, but there will always be a very good mix of large caps, mid caps, and small caps wherever we see good earnings opportunities and a price value gap. If we look at the sectoral breakup, around 1/3 plus of the portfolio is exposed to the infrastructure and engineering segments. Around 15% of the portfolio is comprised of the financial segment, which is the next biggest sector. After that is consumption, which is around 10%. Then there is automobiles, around 9%. Then IT, telecom, chemicals, each are about 6% or so. Energy and utilities are 2 to 3% of the portfolio. So we have a very good mix of sectors. Our bigger bets are on the infrastructure and engineering space. And within that, there is a very good mix across various segments of power, ports, etc. The key additions in the quarter gone by have been on the IT side. We did not have any exposure. So we have taken exposure to KPIT Technologies, which is a leading player in the auto ER&D space. It is exposed more towards a software-defined vehicles, wherein it supports OEMs on middleware. The growth outlook for this company is quite robust, with around 20% plus kind of growth levels, and it is has a client list which comprises of most of the large OEMs globally. The second addition that we've done is of Kirloskar Oil Engines, which is amongst the largest players in the genset area, and it is a very good play on infrastructure, rising digitization, and the entire power backup ecosystem in the country. If we look at the business performance of the underlying portfolio companies, and this data we've presented ex the oil marketing companies, because the oil marketing companies' performance does tend to be volatile. So if you look at our portfolio companies, their operating profits have grown at about 14% in the quarter versus 8% for the Nifty. Similar kind of numbers we are seeing on the PAT side as well. The outlook for the next couple of, if you look at the whole of FY25 and FY26 as well, we believe that our portfolio companies will continue to outperform the Nifty, both on the operating profit side as well as the PAT side, as far as growth in earnings are concerned. And this is not something which is just a forecast for us. If we look at the portfolio companies' performance over the last 5 years, if we take the last 5 year CAGR of our current portfolio companies, what we see is that they have delivered PAT growth numbers which are in excess of the market. So it is not that, we are just forecasting good numbers. The companies have actually managed to deliver these kind of growth numbers in the past as well. The return on capital profile of the companies also continues to be quite good, because our portfolios always comprise of high quality companies, and one of the important parameters of quality is the return on capital. If we look at the PE ratio of the overall portfolio and we take the average of the last 7 years or so, then obviously the portfolio is trading at a lower multiple than what it has traded on an average in the last 7 years. While there has been a change in the portfolio mix during this period, we believe that given the inherent earnings profile of the portfolio, given the quality of the portfolio, whether it be in terms of return on capital, management quality, leadership position of the companies, we believe that there is good re-rating potential that is resident in the portfolio today. If we look at the key financial parameters of the portfolio, we have underlying return on equity, which is around 24% for the portfolio today. The underlying return on equity for, let's say, Nifty is around 16 to 16.5%. So on that count, the portfolios scores quite well. If we look at the earnings growth, as we've seen in the previous slide also, that continues to be better than the overall market. If we look at the leverage or the balance sheet ratios of the portfolio, that is also quite healthy versus what is there in the market. The portfolio is trading at a premium to the overall market, but we believe that is more than justified given the higher earnings growth, given the better return on equity and return on capital profile, given the better management quality, and given the better balance sheet ratios. So thank you so much for your patient hearing. And Gaurav, it'll be good to take any questions that are there from investors.
Sure, Sandip. Thank you so much for a detailed brief on the portfolio sectors as a lot. I request all the participants to type in your questions on the chat box, and we shall try to curate all of them. Sandeep, you spoke about interest rate, interestingly, and in a recent article by our finance minister, she said the cost of borrowing is really very stressful. And at a time when we want industries to ramp up and move building capacities, bank interest rates will have to be far more affordable. On this context, what do you think? How quickly we can see that transforming into our economy? Because end of the day, that also has a link with the valuation of the growth companies.
Sure. So the capacity utilizations in the country are, in the region of around 77 to 78%, let's say closer to 80% or so. That is generally a time wherein the private sector capex cycle picks up. And obviously, all corporates would like interest rates to be lower because that will reduce the cost of any project. And to that extent, a lower interest rate is also desirable for equities as well, because the cost of capital comes down, the discounting rate comes down, and growth in some sense starts to pick up. RBI, on the other hand, is actually quite focused on inflation, and its mandate is to bring inflation in the comfort zone, let's say about 4% or so. And while it is within the range, RBI wants to bring it down decisively, because once the rate cutting cycle starts, it would not like to see inflation shooting up. India's interest rate cycle, the cut cycle, will lag the global cycle. Globally, we've already seen interest rates being cut by the US Fed by around 75 basis points. In India, the last inflation print was not great from a rate cut perspective, because food inflation was quite sticky. But one would like to believe that a bulk of the heavy lifting on the inflation side has been done, and we could see the rates coming down in next year. So, that would be the outlook on interest rates. And if that is the scenario, then obviously it should benefit growth style of investing and equities. Within equities, the one thing that we would need to be watchful of is how global trade starts to behave once the new president takes office in January next year.
Thanks, Sandeep. The next question would be, Sandeep, like there's a classic dichotomy, whenever you ask about the valuation, there will be certain sectors which are undervalued, there will be certain sectors which are overvalued, right? And current context, if we see that we have been not into IT for a few period of time, and we have added KPIT, and which again is a part of the overvalued sectors which is being envisaged in the market, and undervalued would be probably a banking sectors. Your thought on that? Like, are we doing any juggling in between, or is completely depending on the bottom up stock picking capability of ASK?
So, Gaurav, our stock picking style continues to be bottom up. Obviously, we are quite focused on valuations whenever we make any investing decisions. For us, margin of safety is one of our key guiding principles. Sectors valuation calls really also need to factor in the growth dynamic. IT sector does seem to be expensive versus the potential growth that it offers. We've invested in KPIT because the growth that it offers is more than double of what the IT sector in general as a basket offers. So the IT sector growth levels are between the range of 8 to 10%. We expect KPI to deliver something like 20% or more. So that is the reason for picking up that specific stock. And for us, generally when we evaluate businesses, we would like them to grow, above 15. And that is one of the reasons, above 15% and, more likely 20. But generally the higher growth stocks, valuation levels are also higher. So once we factor that in, then, the number of stocks that fit into our criteria are lesser. Because of the growth aspect, the IT sector has not been one of the favored sectors for us. And that has been the reason for, not liking a lot of the banking and financial space as well. So while that continues to be attractive on the valuation side, the growth that it offers, many of the banks is, not significantly above 15%. And so in spite of, valuation comfort being potentially there in that pocket, we've not, had a very large position there. Valuations, Gaurav, need to be looked in two contexts. Sometimes it is looked in the context of growth. Sometimes it is looked at in the context of what the sector has traded historically. But BFSI historically has traded, especially the lending space, has traded at higher valuations in the past. But in those times, perhaps growth was also higher. So factoring the current growth outlook, we do bottom-up stock picking, and wherever we believe that growth can be higher than 15%, closer to 20%, and it is not only for a year, but let's say 3 years or maybe more, is wherein we select stocks. So IT was a sector where we did not have any representation. we were looking for opportunities. This is a company which offers good growth, and hence we bought into KPIT.
Great. Sandeep, when we are speaking about KPIT, there's a follow-up question from on KPIT. The question is, please name couple of major global auto OEM customers of KPIT.
Yes, so KPIT is, works in what is, the software-defined vehicle. That is their key area of strength. And it is 100% auto ER&D focused company. It works in the specific area of middleware, and it counts most of the large global auto OEMs as its customers. And what has happened in the last quarter or so is that some global weakness has also been seen on the auto side, but we believe that increasingly going forward, software will continue to play a more and more meaningful role in the auto segment, and hence KPIT's offerings will become more and more important for the OEMs. It is trying to gain increasing wallet share from all its partner OEMs.
Thanks, Sandeep. Sandeep, in a recent article of yours in Economic Times, you spoke about sunrise sectors like e-commerce and energy transition business. Can you throw some light on that and how we are actually capturing that through our portfolios?
Sure. So energy transition per se is a very big theme, and there are various ways to play energy transition. Energy transition can be played through utilities. Energy transition can be played through electric vehicles. Energy transition can be played through, let's say, ethanol manufacturers. Energy transition can also be played through equipment suppliers that manufacture equipment for renewables, whether it be solar panels or wind turbines, etc. While we like the space, and it's a very high growth space because there's a lot of action that is happening. India has stiff targets which it has committed in COP26 for reduction in carbon emission. The valuations in the sector also continue to be quite stiff. So while we like the space from a growth perspective, unfortunately, from a valuation perspective, we've not been able to find enough comfort. So while we have businesses in the portfolio that have exposure to renewables in some form or the other, so let's take an example. Let's say we own L&T, and L&T has exposure to renewables. We've not been, and we also own Sona BLW, which supplies to global EV manufacturers. So there are some plays that we have in the portfolio which are exposed to the sector, but we do not have yet in a portfolio a name which is fully, we can say, is just a pure play on energy transition. But this is a business where we continue to scout for such names. And wherever we find the price value gap favorable, we'll go ahead and invest.
Great, Sandeep. And Sandeep, in the last quarterly call, we discussed on certain segments or the sectors of the market, which are the market darlings almost 6 months back, and everybody wants to put their money into those segments. And as you know, due to slowdown in government expenditure, due to elections, and of course, other aspects like heat wave or monsoon, and you always say that there's always a latent value in any sector or any stock. So what do you think in respect, considering the government expenditure has been low and there has been a sharp correction specific to segments like infra space or a port space, or something related to where you have money into the defense segment. So what's your take on this basket as a lot?
We believe that this basket will continue to be one of the relatively high growth sectors for the next many years. There could be periods of intermittent slowdown due to seasonality, due to events like elections, etc., which we have already witnessed. So, like we saw that the fiscal deficit in the year so far was quite low because the government was not spending. We would expect government spending to pick up in a very meaningful way going forward. The feedback that we are getting from corporates also is that tendering activity is starting to increase, inquiries, etc., have picked up. And we believe that the work that the government has been doing over the last few years and the projects that have already been announced, etc., those will, that kind of trajectory will continue. Yes, was there a moment of intermediate lull? The answer is yes. But the government has reiterated its commitment to spending. We are hearing the same from on the ground as well. So we have also seen in few sectors the pickup already starting to begin. We've seen that in the power sector, a few large thermal sector orders have been announced. There has also been news flow in the defense sector, and we believe that this is something which is going to see a very strong pickup in the ensuing months, because this is also a period which is a strong construction period for the country as a whole, the next 6 to 8 months. So we continue to be very positive and bullish on the sector. There is a chance that government's original budgeted target numbers would not be met. So government had thought of spending around 11.1 lakh crores or slightly more than that in this financial year on infrastructure capital expenditure. That number is likely to be missed, but the overall trajectory will continue to be positive. And obviously, while there is a delay in spending, I don't think this is anything more than a postponement. And we will see this expenditure getting more than made up in the next fiscal year. And sequentially, anyways, we are going to see a very strong upward trajectory. My guess is that we should see this in the quarterly results, in the news flow, etc., over the next few months as well.
Thanks, Sandeep. While you take on more questions, in the meantime, I'll request all the participants to type in your questions. We shall try to curate all of them. Sandeep, you spoke about the quality and the resilience of our portfolio, and you spoke about some, phenomenal numbers in terms of the PAT growth of more than 25% of our portfolios and ROC of about 34% for the last financial years, 5 financial years in specific. And if I look into the underlying performance of the portfolio, though the last 1 year has been a bit encouraging for us, however, on a sequential basis, if you see, our portfolio is not able to compete enough with the competition or the benchmark. And world is all about relativity. So in that aspect, what you see our portfolio to do going ahead, considering all the quants which we have discussed right now? Are we in a right trajectory? And also, alongside a follow-up, that are we be able to, beat the benchmark or create an alpha over the next 2 to 3 years in specific?
Sure. What has happened in the last few months, especially in the portfolio, Gaurav, is that some of the basket and names that we were exposed to did not deliver the desired performance. Whether it, let's say, be the PSU basket, we own names like IOC, BHEL, REC, etc. Some of the defense names like Bharat Electronics. And there is also an overlap with the entire infra engineering basket. These names were impacted with the reasons that we discussed, like slowdown in government expenditure, etc., etc. We believe that with the like expected pickup in spending, government ordering activity, we will see that trajectory start to reverse. Some signs of it have already been seen in the last couple of days, with the state election results coming through, especially today. With news flow, activity levels, the next quarterly results, etc., coming through, we believe that that will start to reverse. Anyways, we continue to be very vigilant on the portfolio. Whatever desired changes are required, that are getting made on a very regular basis. Some portfolio stocks which were impacted due to these specific events, once their numbers start to improve going forward, we believe it will also start to get reflected in the stock prices. It is also sometimes it is also about expectation, confidence, and sentiments. Confidence in these sectors had come down relatively in the last few months due to muted activity. And as we saw, our portfolio is 35% plus exposed to these sectors. In the strong construction period, we believe all of this is going to reverse.
Great, Sandeep.
And is going to be a source of alpha creation for us.
That's great. Sandeep, now in regard, when I talk about performance in the last 1 year, we have seen quite a bountiful of stocks added in the portfolio. You've done some changes. And like, we want to hear from you, what is your take, like going ahead, what will be the portfolio turnover such so that we can expect this alpha which you talked about right now?
So our portfolio churn rates are not going to be very high. A lot of the changes that we wanted to make, we have made. We have increased our exposure to the entire infra engineering basket, where we believe that a lot of activity is going to happen. So that exposure is in place. Having said that, the markets continue to be dynamic. Wherever we believe that there are opportunities that arise, we will participate in them. But our expectation would be that churn levels are going to be lower than what we might have witnessed, because the major realignment of the portfolio has been kind of done. But wherever there are incremental opportunities that arise, we would like to participate in them.
Great, Sandeep. We got a question on the chat box that, if one wants to invest 1 crore right now in growth, and there are a lot of market experts are saying we have to taper our expectation in terms of the return, what we, got in the last 2 years. What would be your take, right? 1 crore would be invested through lump sum mode, or it should be broken up into STPs over the next 3 to 4 months? There's a question from an investor.
Sure. So for a long-term investor, investing in a diversified fund, it does make sense to stagger one's investments over a few months, because we really don't know how the markets are going to behave in the short term. That averaging, which is done, helps in emotional management, because we get both the ups and downs, and hence emotionally we feel that that was the right decision to take, rather than, let's say, having invested all at one go today, and maybe if some unfortunate negative event happens later in the week, and then we might start to feel that it would have been good to wait for a few days. So from that perspective, it is good to stagger out in a diversified long-term investment over a few months. Yes, it is true that the returns that we've made over the last couple of years have been very good. Equities as an asset class is a double-digit return asset class historically, but it's not a high double-digit return asset class. Public equities, what we've experienced in the last couple of years, a large part of the re-rating for the market as a whole has been done. What one should expect going forward is maybe more of returns in line with earnings growth, rather than expecting re-rating. Obviously, there would be specific stocks that would still have potential to re-rate. So to that extent, return expectations from the recent experiences in the past surely need to be mellowed down. But equities is a long-term asset class, and we should not necessarily look at returns only in a year or so. And we should look at long-term returns over a period of time, and the focus should be more on the power of compounding. If we look at the longer term, the power of compounding really helps, and the numbers after a certain elongated period of time do seem to be quite staggering.
Great, Sandeep. As we are nearing the end of the session, I would request again all the participants to type in your questions. We shall try to curate them. Now, Sandeep, moving on to the next section of our webinar, I'll be taking few questions on stock specific. I request you to address them. And in the meantime, when you spoke about this, yes, return perspective, the earnings, it should be linked. And I remember last quarterly call, I asked about Sirma SGS, and this was, it was not doing great. And what happened to Sirma? Suddenly it has bounced back and it's doing pretty good. And your take on that particular stock?
So the EMS space as a whole has very high opportunity in terms of growth. India imports a large number of electronic components, PCB boards, etc. Sirma SGS is one of the largest players in the EMS space of PCB assemblies. It was always very well positioned. Unfortunately, it was going through a lean phase in terms of margins. While revenues were coming through, it was disappointing on margins. What happened was it showed a good quarter of margins, which happened in Q2 FY25, and the stock reaction was because of that. We believe that the entire sector has a lot of potential. This was a name which was relatively undervalued or more attractively valued because of a lackluster delivery on the earnings front. Once the earnings came through, market confidence in the management, in the company revived. Anyways, the sector as a whole had a lot of potential. We continued to hold on to our position, though it was, it did give us a lot of pain for a couple of quarters or more. But our conviction levels were there because of the underlying business potential. That seems to have played out, and we anyways continue to be watching all our names on a very regular basis. And we will be doing that for this as well. So I don't think that anything has fundamentally changed per se for the sector. The story on that count continues to be robust. It was more to do with the margins and delivery that came through. The business is expected to continue to grow at 30% or so growth rates going forward as well.
Wow. Sandeep, on a lighter note, I believe the stocks which we are discussing right now, and that takes a U-turn by the next quarter. So we would like to have a same kind of story for Titan as well. Last quarter also discussed on the same. What's happening there? Are this the wedding season going to add some shine to Titan's glory or the luck going ahead? What's your take?
So India reduced the customs duty on gold from 15% to 6%. In the last quarter, and that resulted in a 9% kind of an impact on the inventory which Titan was holding. And this will continue to have some impact in this quarter as well. It is not specific to Titan. All the jewelry companies will have witnessed a similar kind of an impact, and they will also witness an impact this quarter as well because of that. That has led to the impact on Titan. So that was one of the key reasons. Then there has also been some concerns around lab-grown diamonds. There has also been some slowdown or muted consumption growth trends. We do continue to be positive on the wedding season. Obviously, part of it will get impacted, the numbers will get impacted by the inventory impact that we will see in this quarter as well. Also, there was part of preponement of demand because gold prices had come down. So that was also there. But net, the long-term growth story for the company remains intact. This was more of a one-time impact. And obviously, the shift from unorganized to organized, that shift continues. Titan's positioning, the trust that the brand commands, the robust returns on capital that it makes, all of that continues, and we continue to like the name because of the same.
Cool. Now, if my next question would be on, we have seen that you have increased exposure to Navin Fluorine and Mankind Pharma. Like, what's your take? Because we have seen that specialty chemical has got an overhang over the past 2 years. What's your take now on Navin Fluorine and subsequently Mankind Pharma? If you can put some thoughts.
So Navin Fluorine was impacted by the global destocking in the spec chem business. Large part of the pain is behind us, while the margins had kind of gone to 15% kind of levels, and the business has the potential to deliver more like 22%, 24% kind of margins. We've already seen bottoming out of the margins. The refrigerant gas business and the CDMO business, new capacities are coming up, which will aid growth. And the specialty chemical business, the margins have bottomed out. So to that extent, the business, is now well positioned. On Mankind Pharma continues to be amongst the faster growing, large domestic focused pharma companies in the country. Their chronic business continues to outpace the company average. So their mix of product sales is improving. Their productivity levels on the chronic segment are relatively lower because the PCPM, or the per capita per month sales that their medical representatives achieve on their chronic products is far lower than what their potential is. So that is also going to pick up. Their growth numbers, in our view, and their margins both are going to be very good going forward. So that is the largest pharma sector position that we are carrying in the portfolio, and we continue to be bullish on the name.
Sandeep, we will take one more last question for this webinar. Talk of the town, Adani, and we have a few exposure into Adani family as well. So your take on Adani currently.
So we have two names of the Adani group in the portfolio, Ambuja Cements and Adani Ports. Ambuja Cements is a net cash company. It's an entirely domestic focused company. 80% plus of the sales are retail in nature. It is perhaps the second strongest brand in the cement sector in the country. We are entering a robust construction period post the festive. We have entered the robust construction period post the festive season. Generally, this is a time where we also see increases in cement prices. There has been some cool off in crude prices, fuel prices, which should also aid margins. And this is a company which has no international linkages per se. The second company that we own is Adani Ports. So both of these companies, so the entity which has there has been news flow circulating around has been Adani Green, while we own Ambuja Ports and Ambuja Cements and Adani Ports. Adani Ports, the peak debt levels are actually behind us. The company henceforth is actually start to repay debt going forward. So for its growth going forward, it is not dependent on any incremental international funding at all. And all the growth is going to be funded by internal accruals, and in fact, it will repay debt. So we don't see any impact on the businesses of both these entities because of whatever we have seen in terms of negative news flow surrounding the group per se. We continue to expect a double-digit kind of EBITDA growth for Adani Ports. It continues to have 25% kind of market share in India's port volumes. It is the largest player in the sector. And the leverage ratios, whether it be in terms of debt to equity, debt to EBITDA, they continue to be good. And it is building a large logistics business, a non-port logistics business as well. So both these companies have strong fundamentals, not dependent on any external funding, and their balance sheets continue to be in a very solid footing.
Thanks, Sandeep. Sandeep, we got a last minute question. Depends on you. How will you take on this question that though this is a call on growth portfolio, any comment on your lighthouse portfolio? As you know, that's quite the talk of the town right now, lighthouse performance and lighthouse portfolio and such. If you would like to, attempt.
Sure. So the lighthouse portfolio is a portfolio which is exposed towards sectors like manufacturing, infrastructure, energy, defense, and all the associated and allied segments. Those sectors, as we've been discussing throughout the call, have been impacted by elections, heat waves in Q1, monsoons in Q2, and then the festive season. We believe that we are the lull in activity is behind us. On the ground feedback that we are getting is that activity levels have started to pick up. Anyways, this is a strong construction period. Ordering activity is expected to pick up. So we remain very bullish on the on all the sectors that we are exposed to in the Lighthouse Fund.
Great, Sandeep. Would like to have your closing comments. Then we can conclude the call.
So the growth numbers for the portfolio continue to be in excess of 15%. We have made changes in the portfolio over the course of the last 1 year or so to align it more towards sectors in the economy wherein we believe that growth is going to be quite robust in the next few years. There was a lull in activity in the infra engineering kind of a space in the last few months, which is now expected to pick up. The quality of the portfolio continues to be quite solid, as displayed by the return on capital matrix, as displayed by the management quality, as well as the leverage ratios. And we continue to make changes and adjustments in a very agile manner wherever required. And we remain convinced on the long-term prospects of the fund. Thank you so much for your patient hearing.
Thank you so much, Sandeep, for your time, and thank you all the participants for attending today's call. And we shall be sharing a recording of the same. And this concludes today's call. Thank you.
Thank you.